Well, let me just make a brief comment about why I think this is so very, very important to young people, this financial literacy. And I'm going to talk about a fairly narrow piece of that, but a very important one. But financial literacy, if you have it, is literally a life changer from everything that we know from surveys and studies. Understand that about half of the people in our country do not think they're going to have enough money for retirement. 40+% of people, adults in our society, do not have the ability to deal with a $400 emergency. And at this point, credit card debt has never been higher. And what we know is that people who become financially literate, they are not the ones that carry the major debt. They are not the ones that don't have money to take care of emergencies. In fact, when they're young and they're financially literate, they have two things probably going for them. Number one is that when they get to college, they're going to find out that getting good grades is very important. That's at some level what it's going to be all about for young people. But the other thing that leads to success in college is money. It's money. And unfortunately, a lot of people aren't able to get that together and get what they need out of a college education. So if you are financially literate, not only are you more likely to get through college, but you're likely to make more money than others. You're likely to retire earlier. You're likely to have the kind of money you need to retire. You are likely to have better relationships with the people in your life, because when people struggle with money, relationships tend to deteriorate. And finally, kind of what goes around comes around. You as a parent will do things for your children to make sure that they are financially literate. So my job is to get young people started in the right direction, and to even help parents get their young people started in the right direction. So I'm going to focus on 10 simple investment decisions. These actually come out of a book of 101 investment decisions guaranteed to change your financial future. And the reason I'm focusing today on these 10, well, for some reason, it's not forwarding. Let's try this. There we go. These 10 each are worth $1 million over your lifetime. Now, obviously, the younger we can get you involved in the process of saving and investing, the more the impact, and you'll see that in just a second. But literally, these 10 decisions are each individually potentially worth an extra $1 million. Now, I've got to make a spoiler alert here. I've got you've got to know this, because anybody who comes to talk to you about the past is going to know things that you don't know. But they also know there is no risk in the past. We know exactly what you should have done. And so we give you advice, whether it's Wall Street or the academic community or your neighbors. We give you advice from the past that we saw that worked. And of course, we can't know, nobody knows what the future will bring. But I do believe this, that if you tend to these 10 points, that you will have all of the probabilities from everything we know about the past in your camp. Warren Buffett said, and this makes me feel good that he said this, and I believe it's true, to be a success, and he was talking about in life, not just as an investor. You only have to do a very few things right in your life, so long as you don't do too many things wrong. And while I would love to think that you would be a success if I simply told you the right thing to do, I fear for you that other people want you to do the wrong thing. Now, when I say the wrong thing, remember, I'm looking for these million-dollar decisions. But in some way, oftentimes what happens is that people who are selling financial products are selling something with their own million-dollar decision in mind rather than yours. So sometimes I will say harsh things about other ways to invest, but understand it's because I think those are the wrong things to do, and I want you to know the difference. Three keys. You start it. How much you invest, and we'll talk about that in just a second. When you invest, where you invest, how much those investments grow. I am sorry to say that a lot of what you will end up with 40, 50, 60, 70 years from now is going to be about luck. Now, I don't mean the kind of luck that one would have with a lottery. I mean the kind of luck that you happen to be a saver and an investor at a time that it was like picking up money off the ground. And other times, for long periods of time, returns are relatively low. So I would wish for all of you that you happen to grow up and save and invest during the really easy period, but we have to know it may not be the easy period. And I'll get into that a little more later. And as I said before, for every extra 0.5% that you can make on your investments, you should pick up an extra $1 million. Well, the first big obvious decision you have to make is whether you save or you spend. I cannot be there to control that. I cannot give you advice that will overcome the emotions of wanting to spend versus it just seems like a long way away before you're going to realize the rewards of saving. But I want you to realize something. There's a short list of people who do want you to save, and they want you to invest. And those people tend to be mom, dad, grandpa, and grandma. And you've just about exhausted the long list of people who want you to save. But I want you to think now, with that in mind, with those people who love you and how they want you to act, what about the people who want you to spend? How long is that list? How many people can you think of that want you to spend? Well, the more you think about it, the more you're going to realize that you are surrounded by people that want you to spend. In fact, when I was your age, I was surrounded by very few people who could get to me and convince me to do something unwise with my money because we didn't have the internet. And even just that one thing has given the large organizations access to you as a child, as a young adult. And they are very sophisticated in how they sell products. So between Google and Amazon and a handful of other outlets on the internet, they are going to do everything they can to get you to spend. So it's difficult, even with your parents, to be there to protect you against what they want you to do. And I'm not saying you shouldn't enjoy the good things in life. But the fact is, most of the things we spend money on within 9 months are of little to no value. Now, having said that, there is an enjoyment of life that surrounds those things that have limited value. But I want you to focus on saving for the long term, because the fact is that saving is spending, but it's spending later. It's still to be used to either spend, for example, in retirement someday, or to leave to others, or whether it's family or charities, nonprofits. That money will be used later. Now, Warren Buffett also said, do not save what is left after spending. Spend what is left after saving. And what most people in the industry say who want you to save, they say, pay yourself first. Put that money aside and devote it to you and your financial future, not somebody else's financial future. It is amazing. These numbers, I'm not sure you're actually going to believe these numbers, but these numbers indicate, I'm going to grab a pen down here and see if I can point to the numbers I want you to see. I want you to see what $1 a day from birth to 65 turns out to be at a 10% compound rate of return. Now, I use 10% because that is the compound rate of return of the stock market over the last 92 years. I don't mean every year it made 10%, but whether you look from 1928 to 1950 or 1950 to 2020, it's about a 10% compound rate of return. You don't have to be intelligent to get it. You just have to know that you need to be exposed to the market. $1 a day. And what I'm thinking is, if you really believe this, when you have your first child, you might even suggest to your mom and dad that they might want to work with you to start that $1 a day investment when that child is born. Maybe you'll do it for them for the first 15 or 20 years and then expect them to continue it. But I want you to see, this is not a small item, that what we have here at the end of, let me just get rid of these pictures so I can see the actual number, $1.8 million. On the other hand, if you wait just 10 years, just 10 years, 10 times $365 or $3,650, that $3,650 led to a difference of about $1.1 million. That is the impact of early investing. That is the magic of compounding. And if you waited until you were 21 to put that money aside, it's $238,000. So this is $1. This is nothing. It's a, what is it, a third of a latte or something. So the sooner you can get started, the better off you are. You don't have to start with a lot. You can start with a little, but people who start early, having a saving attitude, typically continue to do that, but continue to save more. So that early saving is really a big deal. Then you're going to walk right into a decision that is potentially worth 10 times $1 million. I know it just doesn't seem possible, but with you investing, not today necessarily, I would love it if you could, but when you get your first job, and if you Pay yourself first. And if you put away 10% of everything you make, sounds like a lot when you're getting started. I talk to a lot of young people who come out of college and go to work actually making pretty doggone good money. In fact, when I came out of college, my starting salary was $454 a month. $454 a month. I just talked to a young fellow whose first year salary is $135,000. He doesn't have a master's. He doesn't have a PhD. He has an education that society honors in terms of what they're willing to pay for it. But I've seen a lot of people come out and make $40,000 and $50,000 as well. So what was I making? $5,000 a year. That's inflation, by the way. That shows you the impact over the long term, from 5,000 to 50,000, from 5,000 to 100,000. That is the impact of inflation. But let's talk about that magic extra $10 million in this one decision. And there are a lot of people who are making the decision to put their money safely into bonds. What is a bond but a loan? A loan from you to a corporation, a loan from you to the US government, a loan from you to a bank to buy a CD. It's the equivalent of a loan because they promise to pay you back everything you put in plus the interest, and they attach that magic word, guarantee. Ooh, people love that word. Well, that guarantee, I want you to see what it cost an investor from 1928 to 2019. If they invested $100 in the government bonds at about 5% over that whole period of time, the $100 would have grown to $10,000. On the other hand, in the stock market, and I don't mean because you picked Microsoft when it came out or Google or Amazon, I'm talking about just owning all the dogs and the good ones all in one bunch, that $100 would have grown to $600,000. Now, do people understand the implications of that? I'm not sure they do, because millennials who are saving, 30% of them refuse to put their money in the stock market because it's risky and you might lose money. Well, that's true on a short-term basis, but I want you to notice the difference between the long-term return of 10,000 and the long-term return of 600,000. So let's say you do decide to go to the stock market as the place to invest and grow your money, that you believe the future will somehow be something like the past. It won't be the same, but something like the past. That corporations will continue to grow and will face, like we did in that 92 years, wars and depression and a pandemic. I mean, all of these things are a part of what we have gone through to get where we are today. But you're going to make a decision, and it's a huge one. And when I was young and I started investing, I made this mistake. I invested in a way that was very risky, because it's real easy for a young person to think, boy, why should I be a monkey and settle for the market rates of return? Market rates of return are for old people. I want to outsmart the market. And it is amazing to me how many people believe they should be able to outsmart the market. But in fact, when you own one stock, the odds are that, number one, you have the risk of losing everything, total loss. I had friends who had all of their retirement in Washington, mutual stock, and it went bankrupt. Their whole life savings within a few years of retirement. And that is because they believed that was a great company. Well, yeah, so was Sears Roebuck when I was your age. When I was your age, there was one company that people knew you could go to work for, and when you got to retirement, you'd have more money than you needed. In fact, the myth was that if you were a janitor at Sears Roebuck, that you would likely retire with over $1 million. And by the way, $1 million back then when I was your age is today worth about 5 or 6 million because of inflation. That's what it would take to replace what $1 million would buy back in the 60s. So one stock versus literally all stocks. I mean, literally, if you owned all stocks, you would in fact likely make a better rate of return than with one stock. I know it doesn't particularly make sense, but let me share some information. I'm not asking you to do any studying after this presentation, except I hope you will read those 2 free books at my website. One is for first-time investors, and the other is for the list of 101 investment decisions. But here's something worth reading. There's a study done by a Dr. Bessembinder out of Arizona State University. They looked at the returns of every public company in the United States since 1926 through, I believe, 2017. And they tracked that performance. And they followed the value of the total market every year based on what all those companies did. Well, here's what you need to know. 1 out of 25 companies made great returns. 1 out of 25, 4%. The other 96% on average made 3% a year. So all of us who think we can outsmart the market, it turns out we are more likely to get a good return from owning the market versus owning individual companies. Now, I've been around this business for over 55 years, and I will tell you, I have yet to meet the first investor in individual stocks who would agree with me, because they believe, and it makes sense because humans have a lot of self-confidence. And they think in most cases that, yeah, the average investor doesn't do very well, but I'm not an average investor. I know how to look at the balance sheet and the income statement. I know about the competition. I know how to evaluate the management. I know how to evaluate the general economy and how that company's likely to do. Well, the fact is, they feel that way. That's human nature. We think we have more control and more knowledge than we do. If you don't believe that now, I can almost promise you will by the time you get to be 76. I hope you'll look, don't read the whole study, read the conclusion, and you can find it on the internet. So the way that you do this, and people have been doing it since 1924, is to do it using mutual funds. And all a mutual fund is combining money from a whole bunch of people and putting them under professional management, diversifying broadly to treat you literally with $100 in a mutual fund. They diversify it as if you have $1 million. It is an amazing investment product. And you can do it, as I mentioned, with very little money, and you can get out of it any business day of the week. If the stock market is open, you can get out. And these mutual funds are built as families of funds, so that if your grandparents need conservative income-oriented funds, they have those kind of mutual funds for people like your grandparents. For first-time investors, they have mutual funds that are built for growth. And in a few minutes, I'm going to talk with you about what I consider to be America's #1 retirement investment, not a short-term investment, but for the long term, because literally you will be able to make one very simple decision and your money will be managed professionally at almost nothing, for almost nothing, to be taken care of. So as you age, the portfolio in essence changes to reflect, so that when you are a grandparent, you will have a lot more income in the portfolio. But then a man came along by the name of John Bogle, and in 1976, actually a few years before 1976, he didn't know it, but he got really, really lucky. He was fired from a job, not because he did a bad thing, but because the stock market did a bad thing, and he was not needed anymore to do that job. And so he looked around for a way to help people, and the way he decided to help people was to buy a kind of mutual fund that had never been developed before or offered to the public. There were some banks who had something like this for very, very wealthy people, but not for the public. And in this fund, it was not about picking the right stocks, picking when to be in the market or when to be out of the market. They didn't do any of that. They were experts at picking an asset class. So it turns out that you could have a mutual fund that owns all 500 companies in the S&P 500. And because they weren't picking the good ones over the bad ones, or deciding to sell some and buy others, or whatever had to be decided in funds where they did all of that trading around. No, there was no trading. You simply got exposure to the mutual fund at a very low fee. And by the way, that fee, and I'll talk about it in a second, but I will tell you, that fee at a lower level was a savings of about 0.5% a year. So these index funds made it possible for people to make more money, not because that it had anything to do with stock picking, because it didn't. It had to do with lower fees. And they were more tax efficient because they weren't buying and selling. And when you buy and sell stocks, you oftentimes have to pay a tax on the profits. But with index funds, that wasn't a problem. And because you had more companies in the portfolio, not only were you making more money because of lower fees, you were also making more money because there were more companies in the portfolio. But as I mentioned, another fork in the road, and you might say, again, who would buy a mutual fund where everybody is being treated the same, so everybody gets whatever advantage there is to however that fund is managed? If they do a good job, then you'll make more money. If they do a poor job of stock picking, you'll make less money. And if you're in an index fund, you're going to receive the return of the stock market. But if you owned a mutual fund with high expenses, you were guaranteed to make less money than a mutual fund that was charging lower expenses. So the academic community in the universities where professors study all of these things in order to try to tell people the best way to do this or that. And there are literally thousands and thousands of academic studies about how to get the most out of your investments, looking at very little things and very big things. And one of those very big things happens to be the expense. And all of the academic studies conclude that lower expenses are the easiest route to higher returns. So that's a big deal if you could control it. And the good news is you can control it if you only have $100 to invest, which means if they happen to be run there are actually today mutual funds that are run without any operating expense. That's the expense of running the inside of the fund, managing it, doing all the accounting and doing all the transfer things of who owns the shares and keeping track of all of those things. There are now funds that are available. You don't pay any of those expenses, while other funds are charging 1% for the same kind of fund. Now, this is not difficult stuff to understand. This is why I am absolutely confident that if watching this once you don't get it, that by the time you watch it a couple times, or 3 times, or maybe even 5 times, you're going to get it. And these are some of the biggest financial decisions you'll ever make. So let's make it very clear here. You've got this fork in the road. Active management, we can do better, they say. We know the bad companies, so we're not going to buy the bad companies. We're going to buy the good companies. And because we can tell the good companies from the bad companies, we're not going to own very many companies in our portfolio because we got it up here. And we know how we can improve your performance because one, we'll pick good companies and we won't put any bad ones in with it. God, it makes so much sense, but it isn't true. See, by the time you own an index fund versus that actively managed fund, the index fund with more diversification, the index fund with lower expenses, the more tax efficiency. And here's the killer. Here is the number, the statistic that I hope you will never forget, that when we look over 15 years, and you're talking about a lot more than 15 years, I hope you're talking about making investments that are going to be there for 40 and 50 and 60, and some of them you'll die with still in your portfolio. I'm hoping to do that. It's not dishonorable to end up with a few bucks at the end of your life. It helps if you give some of that away. That makes it more honorable, some would say. But here's what I know. I know that if I'm in index funds, that only about 1 out of 10 to 1 out of 20 index fund or actively managed funds are able to beat the index funds over a long period of time. Now think about that. Here you are, you don't know the future. But here's what you know about the past. That actively managed funds, remember, they charge higher fees, that hurts. And they don't always pick the right stocks, that hurts. That they are going to make less money, but let's say 1 out of 10 is going to do better. And here's the challenge. Nobody has figured out how ahead of time. And we're not just talking about ahead of time for the next year, ahead of time for the next 10. We're in essence talking about ahead of time for the next 15, 20, 25, 30, 40 years. There was a guy who ran a mutual fund. For 15 years, he did better than the S&P 500. The money rolled in. I mean, literally, bags and bags of mail filled with checks for his mutual funds, because for 15 years, he was number one. Every year he beat the S&P 500. Unheard of. Guess what happened next? For the next decade, he was the worst, or one of the worst 1% of all managers. And so everything that we know about what's in your best interest is the passively managed index funds built for you. And by the way, I might mention, the idea is to leave more money in your pocket. The man who started the mutual fund, the index fund, John Bogle, he recently died. His mutual fund family is either the largest or the next to largest mutual fund family. The fund, when he passed away, had, I think, over $5 trillion. He was as successful a person in that industry as you could find when it came to accumulating money under management. And the reason people came to him with trillions is because he charged a fairer price. On the other hand, there's a family that run another family of funds that have, I don't know, maybe half the funds that the Vanguard funds had that John Bogle started. And yet they are worth many billions of dollars. Why did John end up, not a poor man, $80 million is not poor, but he didn't have billions. In theory, if he had charged the same price as the company that's worth billions and billions and billions of dollars, he would have made a lot more. But no, he wanted you, the investor, to make that money. And that particular mutual fund is the only mutual fund family, many, many different kinds of funds in that one family that has now over $6 trillion. But that family of funds is I think, the number one. Well, you know what I'm going to do? I'm going to hold to that number because I want this number to be right. Because when I tell you how much better the index fund is than the actively managed fund, I want you to forget it. And I think what you're going to do is you're going to subscribe to my newsletter, free, no products to sell, just information to try to help you. And I'll have the rest of that story about why that index fund is so unbelievably special. Now, remember I was looking for a 0.5%? There's so many ways, but now I'm going to show you something about the past. I would love for the future to be like the past. There is no reason why something like what you're about to see shouldn't happen. It may not be as good as you're going to see here, but I will tell you what I think you will get. We don't know. There are here 4 different kinds of index funds. Remember, an index fund is where you get a whole bunch of companies in one batch, in one particular niche, in one group. For example, notice here, USLCB. That stands for US Large Cap Blend. What kind of a mutual fund is that? It's a mutual fund that the companies in there are all some of the largest in the country. In fact, it's the S&P 500 is what we normally think of as the mutual fund that represents the large cap blend category. Company size, these are companies that are worth 70, 80 billion plus, all the way up to a trillion, actually. But the bottom line is they're big companies. They're well-known companies. They are companies that as a group are the highest quality group. So when you look at their return for 92 years, from 1928 to 2019, remember I said 10%? Okay. Okay, it didn't turn out to be 10%. I'll tell you why. We had a depression. That depression started in 1929 until 1932. If you take the depression out of there, this return is much higher than 9.9. But you know something? If you can get 10% and even include a depression, that makes it, in essence, that much better. But now, when you own equities, you get exposed to losing money. The worst single year, because the stock market doesn't just go up, it goes up and down. You've heard a lot about that lately, haven't you? And the worst year was a loss of 43%. The best year was a loss of 54%. But the fact is, and this is so important, you are not investing for a year. If you are investing for a year, if your parents were putting money away for your college next year, let's say, I would hope they didn't have that money for next year in the stock market, because they know that they need that money next year. If you were saving money for a down payment for a house next year or for 2 years from now, you wouldn't want to be in something that could go down 43% or 20% or 10%. You want that short-term need money to be safe. But when we're talking long-term, you do want to take the risk of losing 43 in a year. And I'll show you why in just a second. But I want you to notice there are other asset classes, other groups of stocks. These are large companies too, but they're out of favor companies. They're companies that aren't doing as well. And are you surprised to find out that over the last 92 years, those companies that are struggling, that are out of favor, made more? Wait a minute. We would think that if a company was struggling and not doing as well, that company would make less than the good companies. Well, actually, the way investing works in a large sense is that when you take more risk, you get a better rate of return. Now, the bank knows this. The bank knows this. If you go in to the bank tomorrow to borrow money, and let's say you have some collateral, and the bank is sitting there with you, and they're saying, yes, we see you have a job, you're working part-time, and that you could pay us back over the next year. So we're going to charge you 6% to loan you your money. Next, at the next desk, you look over and you can't believe your eyes. They're sitting at another desk borrowing money from another banker is Bill Gates. And you can't believe it. But you overhear the conversation. And the banker says, well, we're happy to loan you money because we know you're going to pay it back. And so we're going to charge you, and you want to know what they're charging Bill Gates. Well, guess what? They're going to charge Bill Gates a lot less than they're going to charge you, because what? You are more or less risky than Bill Gates. Of course you're more risky than Bill Gates. Something could happen. You don't have deep pockets, tons of money to pay them back. So the banks know this of you. So they charge you more because you are more risky. And they charge Bill Gates less because he is less risky. So over the long term, it turns out with public companies that they can track and see the ones that were out of favor, that because you took more risk in these, by the way, I am not recommending these, nor are the academics recommending these one at a time. In an index, hundreds of them, maybe even thousands of them, because they're more risky. But in fact, most of those companies get turned around and made into profitable organizations. And unfortunately, many of these really great companies fall on hard times. And when they fall on hard times, those prices can collapse, not go out of business necessarily. They can become large cap value companies. So my point is this, is that you are going to have an opportunity to select between asset classes that pay 10%, asset class that historically has paid 11, and here's one that paid 12. Now you'll notice the ones that made 11 and 12 had bigger losses in their worst 1 year. Yeah, they also had bigger gains because look what $100 grew to. $100 grew to about 600,000. I told you about that earlier. But in large cap value, 1.65 million. In small companies, 3.3 million. In small cap out of favor companies, another asset class, 13.2. and $8.8 million. Well, you're probably not going to invest for 92 years. You're more likely to invest between the time you start working and the time you retire for more like 40 years. And so in essence, what you really want to take a look at are the 40-year returns. There's what becomes important. How did these different asset classes, the really big, better companies, the really big, lesser companies, the small, better companies, and the lesser small companies, how did they do over an average 40-year period? Well, the average return for the S&P over 52 40-year periods, 11%. Large cap value, 13.5. Small cap blend, 13.8. Small cap value, 16.2. Yeah, but what about all the losses? What about the bad times? Well, in a sense, there were no bad times. Oh, sure, there were bad times 1 year at a time, maybe even 5 years. In fact, there was a 10-year period from 2000 through 2009 that this S&P 500 lost 1% a year, when the rest of these made about 7% a year. So the point here is this: when you become an investor, you are going to have the ability to decide bonds versus stocks. Oh, I am so hoping that as a young person for the long term, you will be 100% in stocks, because bonds are going to hold you back. Bonds are the brake to your portfolio moving forward. You put on the brakes when you're 40 or 45, not when you're 20 or 25 or 30. You want to be on the gas as long as you're not driving over a cliff. So when we look at the worst 40-year period for the S&P 500, 8.9% compound rate of return. The worst for the large cap value, 8.8. The worst for small cap blend is 10.7. The worst for small cap value, 11.6. But I've got another idea for you. because I think this presentation will hopefully encourage you to dig a little deeper. Because what you can do, if you want, you could put together a portfolio that used all four of those asset classes. So you'd have more companies in the portfolio, thousands. You would have different size companies, different kinds of companies for value versus growth. You'd have massive diversification because you would do this with index funds. When I was your age, we didn't even have index funds. When I was your age, you had to pay 8.5%. So if you put $100 in a fund, they kept $8.50. And then they charged expenses of more than one. You have investments that are so much more efficient today than what I had when I was your age, which means you should be making more on those investments. But the four fund combo, the average return was 13.8%. And that's a huge difference and relatively low. Oh, and the worst 40 years was 10.8%, almost 2% more than the S&P 500. And maybe, just maybe, you might be there during the 40 years when it has the best return. That would be luck. And I want to show you this. I want to show this to you in full color. I hope later you'll look at this more closely. But here you can look at these different asset classes: small cap blend, S&P 500, the four fund combo, small cap value, large cap value. You can look at these in 10-year increments and see who was the best, how much they made. And here's the total over here from 1930 to 2019. But then, if you looked only at the very best, the S&P 500 versus the four fund combo, I want you to see something interesting. The S&P 500, yes, it's high quality. They're great companies, but they had some terrible, terrible times that these combination portfolios did not. And when we go out to a 20-year period, guess what? Yeah, the small cap value, of course they made more money because they're much more risky. But the four fund combo that was less risky than the S&P 500 was number one in every 20-year period. So I want you to add small cap. I want you to add the value to your portfolio. And here's what happens to your return. If we look from 1970 through 2019, 50 years, that's in your lifetime. Using the S&P 500, if you had $100,000, well, maybe you do, but most likely you don't. But if you had that in 1970, that would have been worth over $15 million if you didn't touch it, if you didn't put any more money in. But if you took 25% and put it in large cap value and kept 75% in Old Faithful, you would have made $19.4 million. If you took another 25% and put it into small cap blend, you'd be up to $22.5 million. And if you own all four of these asset classes, portfolio four, 25% each in those four asset classes, you would have had $32.5 million. Now I'm rooting for you. I know luck is a big part of this, but even if you got mediocre returns, it would be a huge advantage, I think, to the long term. And I want you to dollar cost average in. What that means is that if you have $100 a month to invest in, like in a 401k, when you go to work for some company, you put that $100 to work every month. When the market is up, you are going to buy fewer shares. Let's say that the price of your stock or the fund is 20, and you got $100, you're going to get 5 shares. But let's say the stock and the fund went down to 10. It guarantees when you purchase shares on a regular basis, dollar cost average, when the market is down, you are guaranteed to buy more shares. So with $100 at 10, you buy 10 shares. With $100 at 20, you buy 5 shares. What you don't want to do is do this with individual stocks, because individual stocks can fail. The indexes cannot fail. Or let's put it this way. The condition under which the index funds literally fail is the failure of our whole system from everything that we know. But even dollar cost averaging could fail on a short-term basis, because all of these investments are being made for the long run, not for the next year or two. And for crying out loud, do not try to market time. Do not guess when to be in. Do not guess when to be out. There is absolutely, from all of the research that's been done, there is no evidence that individuals trying to guess when to be in and out of the market, there is no evidence that that has worked to make them more money. Zero. And yet, it is the most natural thing to do. And the reason I say it's natural, because it feels like something that you own, that was yours, that was meaningful and important, is evaporating. And that's part of what investing is all about. Living through the ups and downs. Remember, you can always have those bonds where $100 grew to $10,000 versus $100 growing to $600,000. From everything that I know, it is worth the long-term hold in those equity portfolios. By the way, there will be a time when you will want to move into some bonds. And that's why I just for a second want to talk about target date funds. I mentioned America's #1 retirement investment. Here's the beauty. It is, in a sense, better than mutual funds, but it includes mutual funds. Better than index funds, but it includes index funds and the target date funds. Use index funds. Target date funds use mutual funds. What they do is they take the responsibility based on you doing one thing. Select the year you think you're going to retire approximately. And they will do everything else from that point on. Remember, I said it's up to you to put the money aside. You still got to do that. They do everything else. And so if you really don't want to be involved in making these decisions, you can use, hopefully in whatever company you go to work for, they will have a target date fund, hopefully that is built of index funds, hopefully that will have very low expenses. And if you do, it is one sure way to do well in the long term. Now, I have written a lot and done podcasts and done videos about things, little things you could change to do better. But if you just did this one thing, and here's how they work, here's the way it works. Here you are starting to invest here when you're just a kid. All of this blue, that's stocks. Very little in stocks here until you're about 40 years of age. And then starting at age 40, they start putting some bonds in the portfolio. It isn't that you couldn't do that yourself. You could do this, but they only charge a very, very low fee if you're in a target date fund that's built with index funds. And finally, here I am out here at about age 76, 75, right here. And if I were in this target date fund, I'd have about 30% in stocks and the rest would be in bonds, very conservative. Might be very much like what your grandparents are doing with their money in retirement. But here's another one, a different company's target date fund. And when you're my age, they're 40% in stocks rather than 30%. So there are differences. And you will, of course, hopefully read up about these. Now, I just want you to know that tomorrow, if you have an interest, I'm going to be making another presentation about the past, the present, and the future of investing, which will include what I consider to be the 10 most important lessons of the last 50 years. And by the way, why future returns will be better likely than in the past. You already know that. So some of what you would learn, you learned today, but you are certainly invited to come back and join us tomorrow at 10. And then next week on the 10th, I'll be talking about people who are close to or in retirement, and what do you do with this bear market when you're in retirement or you're close to retirement? Can you take the right steps that will likely treat you and your portfolio most fairly in retirement? It's a very tough decision for a lot of retirees. And this is my website, paulmerriman.com, where we have lots of articles, literally, I think now over 600 articles and podcasts, all built to try to help you be a better investor. And here's those free ebooks I've been talking about. First time investor, grow and protect your money. Then the 101 investment decisions guaranteed to change your financial future. And then this one is for when you get older, but it is called Get Smart or Get Screwed, how to select the best and get the most out of your investment advisor. So I certainly hope that I can continue at some level to help you through the articles and the podcasts and the videos. You can sign up for the free newsletter. And on top of that, if you do sign up for the newsletter, you will automatically get a free copy sent to you, not right now because the book's not quite done, but in a few months when we finish the book on the 12, not 10, $1 million investment decisions. And the other half of the book is about a strategy called Two Funds for Life. I really hope you will read that, but the book is free. And now, Jim, I know I talked longer than I was supposed to. I apologize for that. I hope I didn't put you all to sleep, but I'm willing to take some questions if we have time. Huh?
Great. So on the chat, there was a question that came up. Paul, do you have a preferred target date fund?
Yes, I certainly do have a favorite fund family, and that would be Vanguard. Now, BlackRock is equally as good. They have small differences, but Vanguard's a unique situation, and their fees are very, very low. It costs about 14/100ths of 1% a year to manage a portfolio. And in a sense, that's basically like robo-advising. And what you're getting with Vanguard at that very low fee is you're getting their attempt to manage the best they know how for people who have trillions of dollars of money with them. Now, would I put all my money in one of their target date funds? Well, if I didn't consider myself knowledgeable about smaller companies and value companies. So what I have a lot of young people do is add a little bit of small cap to the portfolio. You can do that. We show them exactly how to do that. You can do it at Vanguard. It's a simple thing. You can do it with as little as 5% of your portfolio. You don't have to make a big bet of any kind, but the answer is yes, Vanguard and Fidelity. The Fidelity has some index fund based target date funds, but they also have actively managed funds that are target date funds. And that's not what I would recommend. I would recommend the index based.
Great, thanks. Other questions from the group?
I have a question for you, since we may have one high school attendee. I'm not sure. In fact, if you're with us, speak up, please. We'd like to do that.
Go ahead, Gianna.
I'm a high schooler. I'm a sophomore.
Good. And let me ask you a question about the information that you just heard. Was part of it helpful?
It's got me thinking and gave me subjects to research later on. I'm not sure if I understood all of it, but it was a good starting point, so I knew what to look for in the future.
You know,
or right now, if I'm researching.
Excuse me. So what was that last comment, Gianna?
I'm not sure if I understood it all, but the topics that you talked about were a good starting point for me to look into.
So do me a favor and read the free book for first-time investors. It's a simple read. It's a short read. And as I said, it's free. I mean, you can pay for it at Amazon, but it's free on our site there. And I would love for you to email me, just paul@paulmerriman.com, and tell me if that then took you to the next step of understanding the process.
Okay.
And then let me make this promise to you. I'm not going to be around as long as you are, but I'm going to be around for a while. And when you get that first job, if you're having any trouble figuring out from the 401k plan, the retirement plan that you'll have to invest in, I'm looking forward to an email from you asking what I would suggest, okay?
Okay.
Great.
Do you have any advice for right now for saving?
Well, do you have any kind of a saving discipline right now? Do you put some money away?
I do not have a job, so maybe birthday money and that kind of stuff goes into the bank.
And in that bank, is that money being saved for college or for what?
It's just sitting there. I get, I don't know, like 3 cents a month for a couple months.
Okay, so here's an idea. This is a possibility. Do you have more than $100 in that account?
Yes.
And do you have some of that money that you think you might not need to use for the next 2 or 3 years?
Yes.
Okay. You could learn something here. You could take $100 and you could go to a company called Charles Schwab. Schwab, S-C-H-W-A-B. And they have mutual funds there that you could, index funds, that you could put $100 into. And you could have a growth fund or you could have a lower risk fund. You would have to decide how long-term you wish to hold it. Now, as a lesson, it might be real good in terms of learning something if you even put half of the money in one fund that's very conservative and one fund that's more aggressive. And the more aggressive one would be all in stock. And the other one, you know what, it could be all in bonds. Why don't you do that? Because then you can watch the difference in how they go up and down. Because how much you make is not going to change your life in terms of the money on the $100. But how much you learn could be worth a lot. Because you're going to see your all stock fund go up and down a lot more than the bonds. And see how you feel about that. And hopefully you'll keep that for at least 5 years. And by the end of the 5 years, you're going to find out how much more the stock fund made in the bond funds. And then it's about the time you're going to put your money into a 401k for the long term. And you've already learned that very important lesson.
Okay, thank you for that advice.
You're welcome. Good luck.
Thanks, John.
Paul, I had a question.
Sure.
Great.
So it's one possible conclusion from the historical returns of the different asset classes is, well, I should just go all in on small cap value. What are your thoughts?
Well, the risk is higher, and to say all in, if you actually follow the advice that we give for the 2 funds for life strategy, it takes your age, it multiplies your age by 1.5. That number, let's just make up a number, I have no idea, let's say you're 30, and 1.5 would be 45. 45% of your money would be in a target date fund, traditional balanced portfolio. The rest would be in small cap value. So as you age, you are taking some small cap value out, putting more of the target date fund in. By the time you're 66, you're totally out of the small cap value and you have that target date fund. But wait a minute, maybe by that time you've learned a lesson about small cap value. Maybe you don't like it, or maybe you do. But what you may find yourself deciding, as I have, at age 76, I am 50% in stocks and 50% in bonds. 50% of the stock portfolio, and I'm talking about index funds, is in small cap. 50% is large cap. This won't shock you. Half of the large cap is value, half is the S&P 500. Same thing with the small. Half value, half blend. But I found out my risk tolerance is probably higher than a lot of 76-year-olds. By the way, I run into 76-year-olds who are 100% in stocks. I couldn't take that. That would be emotionally unhealthy for me. But it is a matter of what you trust. And the good news is that you could put some in and watch it for a while. But when you go back and look at that 4-fund strategy and realize, if you looked at your portfolio, that it's overweighted to large and oftentimes overweighted to large cap blend, every piece of evidence from the past would say, you're going to do better, take less risk, and have more money to spend later in retirement if you use the 4-fund strategy than if you use the S&P 500 on its own. And it doesn't get any better if you add large cap international blend to the S&P 500. You are still in large companies that are very, very large and don't have much value in the portfolio.
Paul?
Does that lead to another question, or is that enough?
Lots of questions. No, that's enough. I'll let others go.
Okay.
Hey, Paul, this is really for someone who lives outside the United States, potentially in South Africa, where you've been talking about investing in US dollar assets, mainly US dollar-based companies. How does someone living in a place like South Africa apply your lessons?
Well, it would depend on the laws of investing there, the regulations.
Let's
Most
make the assumption that there are no constraints, which may not be true, but let's assume you have no constraints.
Well, the first decision I would make is I would make a judgment about the stability and the currency of the country I live in. And I have this decision with a lot of Canadians that use our information. I have to guide them on how would you do this in Canada? Well, I know in Canada, they don't worry about the economy long term. So I have them do a position that is also a combination of large and small, because they can get to US ETFs, exchange traded funds, through the Canadian markets. I don't know that you can do that in South Africa. If you can, then what I would suggest, if you trust the economy and you want to invest in the economy, I would suggest that you probably have a third there, a third in the US, and a third in international companies or index funds, if you can get at them. And if in fact, and I know of your interest in South Africa, if in fact they do have access to all of those ETFs over there, I'd be happy to make recommendations of which handful I would recommend for first-time investors.
Thank you.
You're welcome.
Well, there's one more question here on the chat. It says, do you have any advice on how today's market might affect how we approach our investments, or do we approach it in the same manner no matter what?
Yes, but you do invest today the same as you would invest at the peak of a market where everybody feels so overjoyed, like nothing can go wrong. People have a hard time understanding that when things are great and they can't get better, that's bad. When things are bad and it can't be worse, that's good. That is a difficult transition. It's so counterintuitive. So what I have always recommended, and when I was an investment advisor, I pulled out a piece of paper. This piece of paper is on my website. And on that piece of paper, it shows from all bonds to all equities in 10% increments. I want to know how much you're willing to lose, because whether times are good or bad, you need to build, this is my philosophy, your portfolio on what your risk tolerance is. And what happens to so many people is that they enter the market optimistically and they run into problems and they find out they didn't think about losing money. They only thought about making money. So I would like somebody to invest starting today, particularly for a young person. What young people need to understand is that a bear market, a market that is collapsing, is absolutely great for a young investor because you're picking up all of those cheap shares. Now, when I say cheap shares, I mean of diversified mutual funds. So a market going down is good for a young people. It's bad for me, but I've got half my money in bonds to address that risk. So I'm not changing anything because of the direction of the market. At least that's the way I think that most investors should invest. Now, what changes things is when, like so many of my friends here on Bainbridge, they have pensions and Social Security that they don't need any of their money they've got in their investments. Those investments are for their kids, for their grandkids. So what I suggest to them, if they feel like it, because they can do whatever they want, they can put their money in T-bills if they want, but if they're investing for their grandkids or their kids, why not invest the money the way that you would for somebody that age rather than for yourself? That's the way I would look at it. Does that help, or is Or is there another question behind that smile?
Yeah, I think that's a good message, parents. That's why I was smiling.
Okay. It is a pleasure.
Okay, well, go ahead, Paul.
I'm just going to say, thanks for coming. We hope to get this video in front of a lot of young people. We may even decide, in fact, an honest email from you to me would be appreciated, paul@paulmerriman.com, and say, you know something, this may work in a classroom, because I do this in a classroom and it works. And I get actually that students write to me and tell me what they learned, and they get it. But it's different here than there, I think. And I don't know if it loses something, because I'm not there to see their eyes and to know when I can tell they're getting lost. So I'd love to get your feedback on that.
It's a survey that's going to be distributed to each of you. If you wouldn't mind giving Paul some thoughts on that, that would be super helpful. And with that, I'm going to thank Paul again for joining us today and for this presentation. We will have the recording for this up within the week on our website. And I sure appreciate you all for spending time with us today.
Thank you.
All right. Thanks very much.